Hello, good morning.
How are you? Morning.
Fine morning, fine, thanks.
Right. I think we should kick off because there's no time. It's a Sunday. We must go to church. So the sooner the better. I'm sorry. Last night I waited for you guys and you didn't show up. So I thought you were tired.
Tired we were still, but hey, yeah. I think it gave us an opportunity to get to try to clock in some rest because hey, yeah. But I think as long as you're available, we apologize for that because we now we made studio up.
So that's fine. So today we need to touch on transfer pricing. It's something that often comes here and there, and when it comes, it has got so many casualties. So we want to do that, but we gave you an assignment, and I hope you guys are ready to just present just one or two, or you're not yet ready, so that we proceed on jellyfish.
Mm. So I was wondering, like, if we could proceed. We did definitely do it, but the problem I have now is that I don't have power. We did it together on my machine with NRS.
So that's fine. So let us proceed. We'll do that one later on.
Thank
All
you.
right. That's fine. I know Eneris is scared about presenting things and so forth, so but it's fine. Um, okay, let me
It's
look
okay,
at
sis. It's only that now, today I'm reading from where the baby is, so I'm not talking too much.
that's why I'm trying to look at my records. You seeing anything on the screen, guys?
Nothing yet.
Okay, I just want to give you a brief, just about 10 minutes or 5 minutes brief on transfer pricing, just the background theory before we look at past exam questions on this subject area or syllabus area. So just bear with me because I know you love the action of the thing, but it is very important to have the background understanding because questions are not going to come as they are. So if you have got some theoretical backing, you know how to maneuver the terrain because you'll be having the data, you'll be having the knowledge. Okay, so it will be just a recap of what you know about transfer pricing. At this level, I understand that you have covered everything in this ACCA PM syllabus and you want the revision to just kick off as electric as possible. Now, let's talk about the objectives of transfer pricing. But before we do that, I want you guys to just give me a definition, a simple definition of what a transfer price is. What do you understand by the term transfer price? Somebody has written
Mm,
something there.
okay, from what I can understand, like from that term, is we have two related companies, and we're trying to determine or define like the price that they should sell items to each other or between divisions of the same company. The prices should not be too low such that there is no profit. I think it then depends on the accounting policies or the policies of the company, like to say, do they want to sell at cost to each other or do they want to make like a minimal profit, which somewhat talks to what they would have sold the things at to the market.
Actually, a brilliant explanation, and that's good. Yeah, in short, transfer price is actually there to ensure that you know goods are accounted for. Actually, the accountability part of it, and also the aspect that we want managers to feel that whatever they are doing is important. You see, it's sometimes discouraging to just produce something and you are told that no, that one has to be used by company B, which is part of the same company. But you know, if your effort is not really valued, financially or otherwise, you tend to feel like maybe I'm just doing it, but it's not really important. So when there is now a transfer price, you feel like you are doing something meaningful, isn't it? Okay, so those are the objectives of transfer pricing, as you can see on the screen. The first one is goal congruency. Goal congruency is all about doing something with the objective of making the the company prosper, all right, in the longer term. So whatever we are doing as divisions, by the end of the day, we must aim towards a common goal. So a transfer price, being a prize, has got this aspect of forcing divisions to thrive to meet a certain or a profitability goal in the end. Okay, so by the end of the day, we are aiming at one goal. Then, performance measurement, being a prize or being a quantitative metric, by the end of the day, our performance can be easily assessed or measured. It also promotes divisional autonomy. Divisional autonomy in the sense that if what we are doing is to some extent valued, we feel as if we are actually a standing entity or an entity that can make its own decision, because transfer prices are often negotiated. All right. So if they are negotiated, it simply means that they empower divisions, all right, as standing entities. We are not simply saying that they are divorced from the parent, but we are saying it gives those managers in those divisions some power to say we can as well make some decisions. They need to consult us. You understand? So by the end of the day, it promotes what we can say. It actually motivates us, because if you are consulted, obviously you feel like you are somebody of power, isn't it?
Yes, true, sir.
Good. Now, resource optimization uh, or resource allocation optimization. Here we are simply saying that because there is a figure, that figure is not driven, that price is not driven to randomly. All right. So you would have considered certain aspects, like, for example, your production costs. Since you are now worrying about the production costs, or you are considering those production costs before you arrive at the transfer price, that process is going to force you to be seriously accountable. So by being seriously accountable, it also means that the resources you're going to use are also going to be accounted for. So in that process, resources are going to be, resource allocation is going to be optimized. Also, because there are decisions on whether we continue to buy from our in-house departments or in-house division or external, we are going to be forced to then say, okay, fine, if we are going to buy internal, is there an advantage of doing so? So by the end of the day, we are optimizing resource allocation. Whatever decision we are going to do, we are going to make the best possible decision for the company. Lastly, that one is the motivation aspect. Because there is a transfer price, we have already mentioned that. Because there is a transfer price, we will, by the end of the day, be motivated to do more, as long as the transfer price is something that is significant or that is reflective of what we are producing. Okay. Now, what do transfer prices do? Transfer prices are only important insofar as they encourage divisions to trade in a way that maximizes profits for the entire company, or for the company as a whole. Otherwise, they might become dysfunctional. or they may cause dysfunctional behavior if the transfer price is not meeting the objectives of both divisions. If they are so dictative or they are simply imposed, sometimes managers may feel discouraged to continue to do more. Managers do fight on their own. That there is the horizontal politics. Line managers sometimes tend to fight for things which, if you are not a manager, you might say, but was there a need to worry about this? Yes, there is often a need, because those managers are often paid bonuses related to their performance, related to their profitability contributions. So sometimes if the transfer price is so low, you may have a reason to worry. All right. So the effects of interdivisional trading transactions are wiped out on consolidation. So what we are saying is that profit which we make when a division sells to another division, the profit that often arises is not really going to increase the company's profit by the end of the day. This is why we are saying the price is only there to motivate managers internally, or to force some accountability. But by the end of the day, it is not really a profit. The concept of consolidation, all right, intergroup transactions, they are often wiped out. The profit is only made when the product is sold externally. Okay? Unless we sell something externally, we are not going to say as a company, as a whole, we have made a profit. But that profit is essential when we are judging performance of divisions. Remember, this topic is associated with those other topics on divisional performance, where we look at the ROI, the residual income, all those aspects. Okay, this is just part of that group of area. So when you think of transfer price, think of the way of assessing divisional performance. Okay, selling division sales will be cancelled out by buying divisions purchases. So they cancel one another. Then all that will be left, or what will be left will be the profit, which is merely the external price, the external selling price, less any cost incurred by both divisions in producing the goods. All right. So when we make a sale, that difference, when we make a sale to the external market, that's when we are going to get a profit. Any questions on this part before I proceed?
No, not yet from you, Sam. I think I'm following it.
Learning, are you there? Okay, now the cancellation aspect I've been talking about. All right, on the screen there are two divisions and the group company column. Division B core is a selling division. Division K is a buying division. Now, BICO sells to the external market 1 million goods. Okay, or their sales were 1 million to the external market. Then their sales to Division K, actually it's Division K, are 2 million. All right. And then variable costs 2 million, which means that their contribution in this case was, let me just try to locate a pen here. Okay. So this was an external sale of 1 million, and then another sale of 2 million internally. So it means that in total, their revenue is 3 million. All right. Then they incurred variable costs of 2 million. So this means that if we are saying the revenue was 3 and the variable costs was 2, then the contribution should be 1 million, isn't it? 3 minus 2, that's 1 million. Then when we are now looking at the buying division CAD, this division sold to the external market 6 million. So they made sales of 6 million to the external market and made purchases now from division BCO. Division BCO, the selling division, remember, they sold them this aspect. There was this 2 million, remember? So this division is accounting for that, for the sale of the other division as purchases now, because they use that item maybe in their process. So the 2 million is accounted for here. Remember the aspect of accountability, all right? But it is now being accounted for as purchases, all right? And then we also consider their own variable cost of 1 million. So in total, the purchases and variable costs are going to be added as cost. So, and then are to be deducted from the sales of 6 million, which the division CAD made. So the resulting contribution would be 3 million. Okay. Now, we then have to then consider the impact of this on the company as a whole, the impact of this setup to the company. Now, to the company only has to worry about external sales, not intra-group sales. Okay, so since in division 1, the first division here, division BCO, made sales of 1 million. Okay, there were sales of 1 million to the external market, and there were also sales of 6 million to the external market by division CAD. It simply means that the total sales for the company is 1 plus 6, that is 7 million. These are the sales which were made to divisions or between divisions are going to be ignored. They are canceling one another. They cancel themselves. They are wiped out. This is why we put an X there to signify that these guys have canceled each other. Okay, now the variable costs are going to be considered because these variable costs were not intra-group costs. Okay, they are considered external costs, so they have to be matched with the external revenue there. All right, so they have to be deducted from the revenue. And by the end of the day, the contribution is 4 million. So in the exam, your contribution here should equal to the sum of contribution of the two divisions. So here, the first contribution was 1 million for BCO, the selling division, and this other one was 3 million. If we add them, they give us a total of 4 million. So when you cross-check your figures and you see that the group contribution is not equivalent to the sum of the division's contribution, then something would have been wrong. Is that clear, Annie?
Yes, sir,
Hello?
I'm there. Yes, sir, I'm there.
Good.
It's clear.
Now we have got division. We have got the second example there. We have changed the figures a little bit. Okay. With the cursor now, or this thing. All right. So division BCO, all right, the selling division sells 1 million worth of goods outside, and then it sells to division CAD something worth 3 million. Okay, so in total their sales are now 4 million, and the variable costs are 2 million. It simply means that their contribution is 2 million. Then division CAD, the buying division, this one sold items worth 6 million to the external market, and the purchases it made from BICO were 3 million. All right. And the variable costs are 1 million. So the contribution would be that this is 9. Sorry, this is 6 minus 3 minus 1. So it means that the contribution becomes 2 million. Okay. Now, the sales externally for the group company, we are going to take the external sales which were made by the divisions. So division BICO made 1 million external sale and CAD 6 million, so it comes to 7 million. And these intra-group or divisional transactions cancel one another. So there's a 0 there. You in the exam don't put an X, simply ignore that portion. Okay, that cell, you just ignore it, or you simply put a 0. Okay, and
Okay.
the variable costs, yeah, don't put an X in the exam. The variable costs, you add them because they are considered external costs. So 2 million plus 1, that's 3 million. So the contribution is 4 million, which is also the sum of these. And you can see that even if the figures here, the figures on the intra or divisional transactions might have changed, and they and have affected the individual department's contribution. By the end of the day, such changes or a higher profit or a lesser profit between divisions in divisional transaction, it is not going to change the outward, or let me just say the entire group's profitability. Why? Because they are intra-group transactions. All right. They do not affect the entire contribution of the company. It will still remain 4 million. Is that clear there?
Yes, it is. You've put it across nicely.
But which transfer price is the best price? Remember, we said that transfer price should be agreed, should motivate both parties. The decision for the best transfer price is mainly based on what is going on in the external market or the external environment. That is whether there is an external supplier. If there is an external supplier, we are bound to make our negotiations as complicated as possible until we reach the finest decision. Also, it depends when there is spare capacity in the selling division. If there is spare capacity, the negotiation will need to be made significant again. All right, because that has got some bearing on the resulting decision. Also, on whether they can sell or they can externally before selling to a buying division. If there is an external market, we are also going to be affected on our end decision or final decision. How do we set a transfer price? There are two approaches. The first one, market-based approach, and cost-based approaches. On market-based approaches, we are going to be informed by the external price of the item. All right. So if that item has got an active market, the active market is going to inform us on what transfer price we have to charge. So selling division gets same profit on internal and external sales, right? So if that item is on the external market, is there, has got a known price in the market. So even if we are transfer the item to our own division, we're going to charge the same price, all right? So that we make the same profit we are going to make outside. However, the head office might intervene. Might intervene. Okay. Buying division pays a commercial price, possibly less savings. That price less any savings in selling and distribution expenses. Why? Because such expenses, because we are now buying in-house, might not be might have to be saved. All right, might have to be saved. Why? Because the selling division, because it has got a readily available customer, so they must not charge, selling and distribution expenses. Okay, maybe we are just in the same complex. All right, so what distribution expense would you have incurred? So they want to be there. All right, so this is why we are saying we are going to reduce that on the bank. The company as a whole, by the end of the day, would have made some savings. All right. Then cost-based approaches. There are three types of cost-based approaches. Sometimes the examiner will tell you that this division only charges variable costs, which means fixed costs are not going to be included. All right, are not going to be included in the transfer price. Full cost, no profit margin for selling division. This one, it simply means that all the variable and fixed costs are included, but there is no profit element. All right, so no profit element is going to be included in the transfer price. You just have to only include the production costs and we are done. But now this last part here, this one realizes a profit for the selling division. It's normally going to be the most transfer price we're going to meet in most of the questions, because we will be told that there is a cost plus markup arrangement that is there, and the markup percentage is going to be given by the examiner, sometimes 30%, sometimes 20%. All right, so you need to just pay careful attention to the details in the question. All right, so usually transfer price is based.
So can I see something small on the previous slide? 1 second.
Okay. Yes.
Hi, sir.
And you wanted to say something?
Just 1 second. No, I was copying, realizing a profit for selling division.
Shall we proceed?
Yes, please.
Okay, great. All right. So I was saying that transfer prices often have to be a range. There should be a range, not really a single figure. There should be a range of figures which should be acceptable. All right. So usually there is a minimum acceptable figure to the seller. All right. The least possible figure the seller is ready to say, okay, fine, my goods can go at this price. All right. So usually that's the marginal cost plus any opportunity cost. Marginal cost, we are talking of the variable cost. All right. So usually when you come back here, this should be the minimum. All right. The minimum a division manager would accept, plus any opportunity cost. Opportunity cost, remember, is the opportunity forgone in taking a certain decision, isn't it? Or some advantage foregone in taking a certain route. All right. So, for example,
Yes.
if the item could be sold externally and we get a certain contribution, if we are to sell to the division, that contribution which we would have lost is the opportunity cost. Is that clear?
Yes, it's
Okay,
clear, sir.
great. Now, what about the maximum price the buyer is ready to pay? Okay, remember the range is something between the minimum and the maximum, isn't it? My pen here. So is minimum between the minimum and the maximum range. Figures. So the buyer is prepared to pay any price, but not exceeding the external price. So the external price is actually the threshold, the upper threshold, because they would say, okay, fine. If that is the case, let me go and buy from the external supplier. So this is just the basic we need to bear in mind. All right. So those are the notes which you guys could also utilize, because we say that the minimum price is the marginal cost plus the opportunity cost of the item transferred. And when we say opportunity cost, we are talking of the maximum contribution which would have been foregone by transferring internally. So if now these are the common terminologies that often come. If there is spare capacity, all right, and limited external demand. What is spare capacity? What do you understand by spare capacity?
Having more than what you need.
Producing more than what you need.
Yes, like after you satisfied your demand.
All right. Yes. Actually, that one is an indicator that there is a spare capacity. So, what is spare capacity?
I think it's the extra units you have. Mbeke, please rescue me.
I think it's the like in the resources that you've got, if you are not utilizing them fully, for example, labor, or other resources, like if you've got excess of what you need, and then you can and you have the ability to take on a new order.
That's correct. That's correct. So both your answers are correct. Any, don't be discouraged. You're correct there. You're correct. But Mr. Mbeke managed to actually throw the dice on the sender, on the call. So what happens is in spare capacity, we are having so many resources. All right. So which means that we cannot claim that we suffered a loss by doing a certain action, or we missed a contribution. Why? Because our resources are already in excess. So this is why we are saying on this statement, if there is spare capacity, you'll be told by the examiner that they've got spare capacity, and or sometimes there is limited external demand. So already there won't be any opportunity cost, okay, if they supply to the other division. There won't be any opportunity cost. Remember, we said the minimum price should be marginal cost plus opportunity cost of the item transferred. So this opportunity cost we are talking about is subject to the fact that if there is spare capacity, then it won't be applicable. You won't have to charge opportunity cost. So be in mind of the word Yes, the formula is saying minimum price should be marginal cost plus opportunity cost, but opportunity cost has to be justified. Was it necessary to charge opportunity cost? So in some cases, it won't be necessary, and only you have to do is to charge marginal cost only, variable cost. Then there's also this point: if no spare capacity or not enough to satisfy internal and external demand, then opportunity cost is added. All right. So if there is no spare capacity or not enough to satisfy internal and external demand, then opportunity cost has to be added. Why? Because we are now diverting our fully utilized resources to this particular division. So the contribution we're going to get from outside has to be charged on this division. Is that loud and clear? Is that heard?
Yes, sir.
Then opportunity cost is the lowest contribution from external sales. We talked about this. All right, so the maximum price is always the market price. We have already indicated that, but it can also be negotiated, okay? Where the divisional manager would approach the external supplier to say, "Oh, guys, we understand this is your price, this is the current the going price, but can you guys, give us some discounts?" So it could be negotiated to lowest external market price minus internal cost savings on packaging and delivery. You may negotiate it to some lowest external market price. That is the price of the market less any other, for example, some rebates, some discounts, and so forth, minus any cost savings. Because if we are buying outside, obviously we are going to buy something that has already been packaged, and the supplier might deliver the items to us. So we would have made some savings on packaging and delivery. Hatuzopeke futhi because tatozvitenga zvakapfekwa kunze uku. Is that clear, guys? Okay.
Yes, yes.
All right. So takuenda mu past exam question. Past exam question reganditsvage tione kuti tinoriwana here apa randa pane rimwe randamboona miratoni pana toenda pa the study hub ndikaona the 2024 question, and there's also 2018 question. So we hope we'll do those two. They are long questions, but we'll try to see what we can do. So any guys, you need to present that jellyfish. I know the jellyfish question was good for us because it has got so many variances which we didn't do on the other question. And there's also a revision of there's a revision of the yield and mix variances. So mukatya kuita hapana zvamuri kuita guys. Tiri tese here eni.
Yese ndokunzwai.
Mukatya kuita hatina kwatiri kuita sei kwatiri kuenda. So motoshinga moyo kuitira kuti zvinhu zvacho zviite sei zvifambe. Okay. There is question Caroline from June 2024 exam. Caroline Co. is a decentralized company which manufactures and sells radios. It has two divisions. There are two divisions: the radio division, which manufactures the radios, and the packaging division, which produces the boxes in which the radios are packaged. The packaging division has no external market for its boxes. All right. The expected costs and volume of sales of the two divisions are as follows. So, packaging division, market price. All right, so the market price is only going to be seen in the radio division. Why? Because we have already been told that the packaging division does not have an external market. So it shouldn't be a shock to you, isn't it? Variable cost per unit, the variable cost per unit for packaging division, that's $1 per unit. Remember, these guys produce boxes. So a variable cost of $1 per unit shouldn't be a worry, isn't it? From the commercial sense, the commercial logic, isn't it? Then the radius, yes, 120. I mean, the variable cost to produce a radio is 120 per unit. Annual fixed cost, these ones now are not, the examiner is not saying per unit, so which means they are in total. These ones are in total. Okay. Then annual sales, the annual sales in units, remember, in units. So for the boxes, they sold 20,000 and they also sold 20,000 radios. The current transfer price for boxes is based on the full cost of a box plus a markup of 20%. Remember, the full cost plus markup, the full cost plus that thing which we said it's very, very, very common. Okay. Recently, an external packaging company has offered to supply the radio division with boxes of the same specification as those produced by the packaging division at a cost of $4 per box. The manager of the radio division has proposed two alternative responses to this offer. Number one, the packaging division should be asked to produce the transfer price on the boxes to $4 per box. Remember, the negotiation muscle is being motivated by the fact that in the external market, the same box is now going for $4. So when there is an external market, remember, at the maximum transfer price that a divisional manager or the buying manager is going to accept is the external price. Remember, we said that in the theory, isn't it?
Yes, we did, sir.
Good. So this is why, this is how he's agitated now. He wants now to put his case on the board that the price of these boxes should now be lowered to $4 per box. In which case, the radio division would continue to buy from the packaging department if they agree to the $4 arrangement or proposal. Number two, if the packaging division is not prepared to match the external supplier's price, then it should be closed and all boxes required should be purchased externally. So this guy is actually fuming. His proposals are so, cruel to some extent, is it? There is a fight now. So the packaging division's fixed costs relate mainly to long-term lease payments. So there is what is called oh man, I've forgotten this term now. In IS what is this IS for contingent liability? IS 37, right? IS 37, where we talk of onerous contracts, a onerous contracts where we are forced to incur the expenses, even if you shut down. There is always going to be some cost you are going to meet because of a certain contract. So we are being told here that the packaging division's fixed costs relate mainly to long-term lease, and only 20,000 per year of these fixed costs could be avoided if it were closed. So if we are going to avoid 20,000, remember 20,000 is related to the boxes. Remember our annual sales were in units were 20,000 and the variable cost were dollar. So the variable cost of $20,000 are going to be saved, but okay, they're going to be served, right? So we are then told that a similar amount related to fixed costs here, maybe because of, maybe it could be the labor costs, we don't know, or some other, maybe some, not really labor costs, but things like electricity charges, or yeah, something like that, which is related to the leased property. Maybe because we have shut down, maybe we won't then be able to, be required to pay the electricity charges or telephone charges. Those were fixed. Remember, those are fixed. They're paid maybe monthly. And the moment we close shop, it means that part of that, maybe the 20,000, is also going to be saved, and we'll be left with the 60,000 to be maybe because that will be related to the long-term lease. Remember, maybe the lease would have been to run for say 5 or 10 years. So the moment we close shop, the owners of the building will continue to charge us those lease premium, lease rentals, because there is a contract. So only 20,000 will be saved, but 60,000 will be an issue. So in your discussions, when you'll be discussing, you just have to mention that, oh, the closure is likely to save the company only 20,000, but the remainder 60,000 will have to be borne, and it won't justify the closure anyway. You just have to convince the examiner that you have understood something, right? You did not just ignore because it's a very important point here. A lot of students simply love the arithmetic part of it and ignore such other additional information. All right, we have finished reading the assignment. The essay, the scenario. Now, the question. Prepare a profit statement for each of the two divisions. Each of the two divisions, and for Caroline Company as a whole under the current transfer pricing arrangement. So the wording under the current simply means that before considering these other things by our what? By this director, before these other things. Okay, so you need not to worry about that paragraph. Just do what you must do before considering the other issues there. Is that clear, Annie? Hello, Mr. Becky.
Yes, it's clear, sir. What I wanted to confirm, so the profit statement that we are going to draft is the one like similar to the one we have on our notes, isn't it?
Yes.
Okay.
Or you
And the
guys
consolidated for the company is where we add the two, like where we have the three columns for division
Yes.
1, division 2, and then the consolidate. Okay, all right.
Yeah. Yeah. That's what we do there. That's what we do there. That was the standard, and that's the most common setup you are going to meet in the examination. So once you master that, This is why I say it. The moment I give you the theory, these things becomes easy. You understand? Because the questions are almost going to come in a similar way. All right, so we're going to do this one together, and then the other one, because if I say you guys going to do it, you are not going to do it, so you will do it here. You will share from that end. So we're going to do this one together, and the other one, Annie, be prepared. Okay, I'm looking for my Excel. And yesterday I failed to share the screen properly. I struggled. I hope today I won't struggle. Are you seeing anything there, or you're still seeing the question paper only?
It's still the question paper for now.
Yeah, that's my war with this technology. How about now?
Now we can see both.
All right. That's great. So now we need to then come up with our template, and please make sure you number your things, because on your on your spreadsheet console in the examination, you need to pinpoint. You need to ensure that you have numbered your answers. Otherwise, that might annoy the examiner. So this is part A. It's actually question, let's say it's question 3, part A. Say so because you'll be using a lot of you'll be attempting a lot of questions. Okay, then the profit statement, because in the question they stated that it is a profit statement, so just use their term, isn't it? Profit statement. Okay, and we've got how many divisions? There are 2 divisions, so we just have to create a column for each division. So there is division for packaging division, packaging division, right? We have got the radio division, and then the company, Caroline, the Caroline company. Okay. The figures here seems to be large figures, so you can round them up to thousands, remember, because if you're having 80,000, 500,000, so it might take much of your time to input all those zeros. So you can put some dollar sign, dollar thousand there as the degree of rounding off. Okay. And then what we need now, the question says there is a note. There's a note in the question. Your sales and cost figures should be split into external and interdivisional transactions. I mean, transfers where possible or where appropriate. So which means we need to see these items line by line, the external sales and the interdivisional sales or transfers. So let's start with the external sales. Trying to, when the screen has been shared, some of the the items won't be responsive. I'm trying to enlarge this. Yeah, this time it has become responsive. That's fine. Okay. All right, that's great. Now, we have the external cells, we have internal cells, right? Internal cells. I'm just using a template which you need to know because we are told that one of the division is selling externally. All right. So they are external cells and also internal cells. All right. That shouldn't be a problem. You can lead yourself by just using the template. It's like the way we did on with variances. If you know the formula, if you know the template, it's going to be very easy on the Excel because you'll be inputting the variables. All right. No one is going to create that table for you if you don't know the template. Then after the internal cells, there are no other revenues, so we go straight away to the costs. We are told from the question they are variable costs. The question will tell you because everything will be there, but you only have to know that a profit statement is like an income statement. So you start with the sales, you go to the costs, then to the profit. As simple as that. Okay, so variable costs. What else? They are talking of fixed cost in the question, isn't it?
Yes, yes.
Yeah, sometimes I ask so that you guys won't go asleep there because if I do not ask, then you guys would be taken asleep.
That's true, sir.
Yeah, true.
Yeah,
You should
yeah.
actually have videos on.
When I'm big, stop it. Kulabantwana baleleyo lapha.
Right. So the variable cost, but it seems like I'm not happy. I should create a row on top of because there was a transfer for we want an entry for purchases, right? So I'm trying to because that cell should have a corresponding the internal cell should have a corresponding purchases line. Are we together there? There should be a corresponding purchases or yeah, something like that. Because when you are
Okay.
now, do you get it? It is a sell to
Yeah.
the purchasing to the packaging department, but to the radio division, it is a what? It is a purchase. So let me just say
Okay.
internal purchases. Do you get it? So the template itself will tell you that something is missing. Okay, the variable cost, and then if you want
Fixed cost.
to go before the fixed cost, there should be some contribution. But sometimes if time is running out, no need to write contribution. If the time is running out, right? Because you still have to do the fixed cost and then you need to arrive at the profit. The profit statement is about the profit, which is the final figure, not the contribution. Okay, fixed cost. Are we together? Then profit
Yes.
or loss. So being a profit statement doesn't mean that the divisions are not going to sustain a loss. It is still a profit statement, although one of the divisions might have a loss. It is still a profit statement. Is that clear, Annie?
Yes, sir.
Okay. Wonderful. I think we have input everything that was required. Now, let us now slot in the figures from the question. But already an examiner might actually give you 1 or 2 marks for this template alone. And I say, under exam pressure, he might actually say that, oh, my student simply ran out of time, but he knew what he was doing. Okay. Now let's start with the external sales. We have already agreed, we have been told by the examiner that the packaging division has no external sales. So do not go crazy in the exam and try to slot any figure when the examiner says these guys were not selling external. So please don't put any figure under the packaging division. Now, so the first figure we're going to see is on the radio division. So how much did they sell, these guys? They sold 20,000. So there's only a 20 because the other 1,000 is already on top of the, is on the header there. So you simply put 20 in your Excel. You multiply that by how much? How much was the price, the selling price, the market price?
220.
That's 4,400, isn't it?
Yes.
Great. Annie, are you following? Then let's go to the internal sales now.
Yes.
The internal sales, we are told that the packaging division sold something. All right? They sold something. They sold 20,000 boxes. From the question here, we are told they sold 20,000 boxes to division, to the radio division. So when they sold that, they sold them at how much? How much did they sell them? So you can see there is a need to work out the transfer price. Are we in agreement?
Yes, we are in agreement, sir.
Because we are not told of
I'm
the
not
transfer price
seeing.
there. There's no transfer
I'm
price,
not
right?
seeing. Why
No,
am I
there's no
seeing?
transfer price
You know,
given, but there's the formula.
We need to work out, right?
Yes.
Yes, because we were told that the
excuse me.
transfer price was a full cost plus markup of 20%, right?
Yes.
Are we together, Annie?
No, sir.
Where are you lost?
I'm trying to see where it's saying that the radio division, the packaging division made an external sale. Because the last time I saw, they said the packaging division has no external market for its boxes.
Yes, so we are now on the internal sales now. We want to find the data
Okay.
for the internal sales. So for internal sales, we are having now the this division, the packaging division now has come into action. All right. So, but now, what if they were internal sales? It means they were subjected to transfer pricing. Okay, they
They
were a
transfer to
result.
each other.
Yes,
So
yes, they
transfer
transferred
pricing.
certain items to the radio division. But now, what was the transfer price? That's what we want now to establish. So if we go to the question there, we were told that there was the current transfer price for the boxes is based on the full cost of a box plus a markup of 20%.
20%.
Are we together? So it simply means that we need to have a portion. Okay, you can simply say workings. Okay, transfer price. Okay, the transfer price, we can say, okay, let me just be organized a bit. Okay, so we know that, let us list the cost there. The cost, we are having the variable cost, right? The variable cost, we are how much? Dollar per unit, right?
Yes.
All right. Then we have got fixed costs. How much? There were 80,000, right? But we want per unit, right? So we can say
Divide by
80,000,
20,000.
80 divided by 20, right?
Which is 4.
Yes.
Which is 4, right? So the full cost becomes equal sign sum 5, right? Is that it? I mean the full cost. Then the transfer price. The transfer price now.
We have to add 20%. That will make it $6.
Yes. So transfer price is equal to the 5 multiplied by 1.2, right? So the transfer price is at $6 per box. Are we in agreement?
Yes.
Yes. So that's our transfer price, $6. So now we have the transfer price. We are now ready to roll. So just a little bit of formatting. Okay, now so we come to the internal sales portion. Internal sales, they sold how many boxes? 20,000 boxes, right? 20 multiplied by $6. Okay, or multiplied by this. But now sometimes when you try to, yeah, let us try to take this one, but usually when you try now to migrate this, there will be some problems because other figures, if you want to copy the formula to the other section of the question, there will be some problems because of that issue of locking cells and so forth. Do you get it?
Yeah.
So, okay, let's just leave it for now. You said to look at cell, what do you do? You put a dollar sign, right?
Before and after the letter.
Or like this.
Yes.
All right, thank you. All right. So that's 120. All right. 120,000 there. Let's move on the internal purchases. The purchases, obviously, because you might forget them. So you can simply say equal sign, because they are purchases, so they should be negative. So equal sign minus that one. Already you are done because they should cancel one another. Those items, those two items, they cancel each other. Then a variable cost. The variable cost, we were told that the variable goes to $1 per unit, and they were 20,000 units. So the variable costs equal sign 1 multiplied by 20. That's 20, but remember they are costs. So you can just say -1 or multiply by -20, because it should be negative, isn't it? Is that it?
Yes.
What about the contribution? Contribution. Or before we go to the contribution, we can simply finish the variable cost for the other division there. What are the variable costs? They are saying 120 per unit. So that's equal sign. How many units are we having? 20,000 units multiplied by 120. 2,400. And this is negative. Okay. And we can underline and get our contribution. That's underline. In the exam, you simply have to do these underlying linings after you have finished your table. Otherwise, you spoil everything. Okay. These are the ones. Okay. That's the issue. Why am I having this here when there is a 4,000 there? Or maybe I did not cover this the top one. I only started here, right? So this one is out of shape, right? This one is ignored. The 4,000 is not being captured
Still
by the formula.
getting 188.
What's happening?
I'm getting 1,800.
Yeah, because the 2.4, 2.520 is actually this plus this. So maybe I did not cover everything.
Yeah.
All right. That's it. Okay. Let's move on. The fixed costs, how much were they? The fixed cost that we are told for the packaging, that's 80, right? I can just say -80. All right. And for the radio, that's -500. So what will be the profit or loss? Here, that's equal sign sum. That's 20. Are these the figures you are getting?
Yes.
20 and 1380. Okay. I think we are done in terms of the divisions. Any questions in terms of the divisions? Now let's do the parent. The parent, for the parent, what matters are the externals. The externals, the intra-group, or these ones, this 120 and that one, they cancel one another, we ignore. The variable cost, these ones equal sign, you add across, cosine, sum, okay? And the contribution, so we can simply do this. Is that possible?
Yeah, it's possible.
Do you have these figures? Mm. Are we there?
Yes, I'm checking.
So, that's our profit statement, ladies and gentlemen, and you earn your 6 marks just by this. So, transfer pricing shouldn't be a problem to us in this examination. When it comes, we must ace it. So already you guys are already 50%. At any, when I hear that you
Yeah.
fail, I want to be happy, you know. So we are done. Eh? Please replay these videos. I'm going to send them tomorrow morning.
Okay.
Replay them, share them with your peers. You guys must pass this in. You should be by now, somewhere with these things. But the problem that you were running away all the time. All right. Let's move on, guys, to the next one. Oh my God. I'm not the tidiest person, the tidiest tutor, The screen is scruffy. Let me try to clean it up. Think we are on the part where let me just cross check if we did it. Seems like it was done properly. Yeah. Okay, that's fine. Okay, let us wait here. I'm sure you can see the question. The question is saying, calculate the effect on the profits of each division and Caroline Kanban as a whole if a transfer price of $4 per box is used. So here we're now being told of the effect if we change the transfer price. So if you have done your Excel properly, this shouldn't take even 2 minutes to do, isn't it? In aspect of simply changing the transfer price. Hello?
Hello.
Hi.
So we are saying, let me try to copy these things. And I know I'll be affected by those items called sales, what. How I hate those things, oh.
Okay, that should be your
Chair.
friend because he enjoys them.
Eh?
The students should help him.
Okay. Thank you. So that's B on bracket 1. So property statement. Um, let me just say,
Is
if
it not the adjusted profit statement?
all right, adjusted, and yeah, that's a good name. The adjusted profit statement. Okay, now, do you think there is need to change the figure on the first row there on external sales? Do we have to change that? Has it been affected if the transfer price is now $4? Can the external sales figure for the radio division be changed? Obviously
I'm
not.
not sure.
Mm? Is the external market price going to be affected by your internal transfer prices? Obviously not. Are we in agreement?
Mm-mm.
Guys, the external market price cannot be affected by your, because your internal policies or your internal processes are going to affect the market price. Unless if you are a monopoly, you understand? If you're a monopoly, yes, you're operating, you're the sole provider, so you rule the market, then you can determine, you can effect changes in terms of the prices. But we are not given those facts in the question, so we expect to leave that external sales, figure as it was. That one was not affected. All right. Now, when it comes to the internal sales, now the internal sales, we remember originally it was how much? It was $6, right? The transfer price. Hello?
Yeah.
The transfer price, I've actually highlighted the transfer price here, guys. You're not seeing the transfer price, or you're tired now. You're beginning to be tired, right?
No.
The transfer
Hello.
price originally it was $6. All right. But we are told that we're now changing it to $4. So if we come here, this was the formula which we used. All right. And we had logged it at $6, but we want to unlock it and put our $4 there. Is that clear? It's now $4, isn't it? So everything has changed. Hello.
Yes, sir.
Yes,
Yeah.
So we have removed the $6 which was there to put the $4. So what was affected was the internal sales changed from 120. It was 120 here, as you can see here on this side. Are you seeing it? Where I'm putting this this eraser thing. It was 120, but it is now what? 80. All right. So it has also changed this other part. There's also an 80. That's the importance of putting these formulas in links. If you link them, the work is going to be very, very easy for you. And the rest of the information, the entire group profit is not going to change by such changes. Okay. The entire group profit will remain the same as 1.4. This was 1.4.
please come again on effecting the $4.
All right. When we effected the $4, the $4, remember the formula there was, instead of a $4, there was this $6, which was the original transfer price. But the director is saying that because there is now an external supplier who is ready to give us boxes at $4, I want the division to reduce their transfer price from $6 to $4. Do you get it?
Yes.
So this is why now it is reduced from 120 here. I mean, from the 120, okay, to $8. So the impact was to reduce the internal sales from 120 to 80. All right, but the variable costs are still the same, right? So this means
Fixed costs.
Yes. So the contribution has reduced from the original contribution of 100. The original contribution was 100, right? Do you get it? And the original
Yes,
was 100 here, 100. But because the sales have reduced, it also means that the contribution is also reduced from.
Okay.
Did you get it? The contribution was originally 100, but it is now skissed. Why? Because we have lost a 40,000 from the reduced selling price. The selling price was reduced from $6 to $4. So therefore, or the sales reduced from 120 to 80, which was a difference of 40. So this is why the contribution is also fallen by 40 from 100 to skissed. Okay.
Okay.
Yes, but the profit now, the contribution and the profit, the profit now is now a loss. Are you seeing that? It's now a negative 20 here, which is a loss. Originally, we had a profit of 20,000, but now it is now a negative 20, which is a loss. Are we together? And by arithmetics, you can actually see that that 40,000 drop in sales, the 40,000 drop in sales is affecting also the profit by 40,000. You understand? Because we moved, the profit has dropped by 40,000 from 20 to minus 20. That's 40,000, isn't it? Hello?
Hello.
Are we there? Are we together?
Yes.
So you were saying the profit dropped from 22. Sorry, I was
Minus
still
20.
copying a few things down. From all right. Okay,
20.
it's okay.
All right.
So here you're saying that they stopped buying they stopped buying from in-house. It's
It's
$60.
$6.
At $6, they were forced to buy it at $4.
Yes. That was the proposal by this guy here. This guy was saying the packaging division should be asked to reduce the transfer price on the boxes to $4 per box, in which case the radio division will continue to buy from them. Right? Why? Why did the radio division manager say so? Because an external packaging company has offered to supply the radio division with similar boxes as those of the packaging division at a cost of $4 per box. So this is why he sent maybe an email to the company directorate to say, guys, we have got a problem here. We want the boxes to reduce their transfer prices from $6 to $4. Why? Because we can obtain those boxes elsewhere at the same amount of $4. So the examiner wants you to just readjust the profit statement accordingly if the the transfer price has reduced from 6 to 4. So you can see that when it becomes 4, it means that we are now multiplying the 20,000 boxes by 4 to obtain 8,000 there. All right. But the variable costs are going to remain the same. All right. But the contribution is going to be affected because contribution is selling price minus variable cost. So if the selling price is reduced, therefore the contribution is also going to reduce. All right. But the fixed cost will remain the same. Okay. So this is why we then arrive at a loss of 20,000. Coming to the radio division, as the purchases has reduced, it simply means that their profit is also going to increase. and their contribution as well is also going to increase. All right. The original contribution, if you come here, was 1880. You calculated it yourself, Annie. 1880. That was the original contribution. But now, this time around, it is now 1920. Okay, it's 1920. Are we together, Annie? And the fixed costs are just the
Yes,
same, the 500,000. So the resultant effect of the profit is that it has increased by 40,000 again. But the entire group
on the radio
profit,
division.
the entire group
Oh, when
profit
it's
is not going to
reduced.
change. Hello? So
Yes.
Yeah, I know it's understandable, sir.
yes. So
So please come again also, Nyatan.
okay. All right. Where any?
I'm just following, but I think I need just that one more.
Okay, one more explanation.
Explanation from yeah.
All right. All right. It's fine. It's fine. I'm saying everything, we have copied everything as it was from our first answer here. Okay, before the changes. Now, the change
Yes.
which was only effected was the change in transfer price. So we come back to the item where the transfer price is input, okay? Because it's an issue of data entry, right? The moment if you input
Yes.
wrong data, everything will be actually wrong. Okay, they say garbage in, garbage out. So here, the entry was for the transfer price. Instead of inputting 6 as usual, we are now inputting 4. This is why we put that 4. You are seeing in that this 4 on the screen there. Okay, so this 4, if multiplied by 20, is giving us 80,000. All right, so our internal sales have fallen from the original 120. Remember, originally they were 20,000 multiplied by $6, and this was the $6 which we calculated the original transfer price. All right, but now the transfer price is falling to $4, so the internal sales are 80,000. Now, if the internal sales are 80,000, it also means that the contribution is going to be affected. All right. Originally, the contribution was $100. As you can see on the other side of the screen, the original contribution was $100. Are we together, Annie? This was the original contribution. This 100.
Yes.
Now, the contribution has fallen to 60. Why to 60? Because there is the original sales were 120, but they are now 8. So which means we have lost 40,000. So obviously the contribution is also going to be reduced by the same figure. Why? Because contribution has got a direct relationship between the with the difference between sales and variable cost, because contribution is sales minus variable cost. So any decrease in the sales is going to affect in the same margin the contribution. If we reduce the sales by $10, the contribution is going to decrease by $10. Are we together? So here we reduce the sales by 40,000 from 120 to 8. So therefore, the contribution is also going to be affected by the difference of 40,000 from 100 to 60. So this is why you are seeing the 60 there. But the fixed costs remained the same. Fixed costs remained the same. Are you seeing that? They did not change. Originally, they were just 8 here. They were 8. So they were not affected by the change in the transfer price, which is a manager should be worried now, because you need to worry about how then are we going to meet those fixed costs. Originally, before the change, we were sustaining a profit of 20,000, but after effecting the change, we are now in a loss position. We are now in a negative 20,000 here. That is a loss. Okay, but to the other division, by the end of the day, these guys increased their sales, their profit by 40,000. Why? Because they were now buying purchases which were 40,000 cheaper, $40,000 cheaper. All right, they were now buying the purchases at 80,000. So that 40,000 advantage boosted their ultimate profit from 38,000 here, from 1,380 to 1,420. But all that gain the radio division made did not change the group profit. The group profit remained 1,400 and 1,400 here, which was the original setup. So is this going to motivate or is it going to be accepted by division, the packaging division? Is it also going to be accepted by the head office? What is the impact in terms of motivation? Those are the questions you will have to answer, or you would have to ask yourself, but not on this part. The requirement for part B was just that you just have to calculate. So we did the calculation and we've gained our 4 marks. It's very, very simple, isn't it?
So,
Hello?
when Papa Network, can you hear me, sir?
Yes, I hear you.
What about that? There's a time when I was just researching through it, and they were saying you have to first of all identify who is the seller, who is the buyer. We just worked it out without picking. Does it really affect any calculations or any thinking process?
You're right. You're right there, Eddie. All right. Okay. From the information, from the figures on the table here, you can tell which one is the buyer and which one is the seller. We are saying when we say internal sales, we put the figure on the packaging division, which means these are the sales which were made by the packaging division to another division. The reason why we call them internal sales, it means that they were interdivisional. Right? So by actually slotting this amount here, we are actually saying that the packaging division is the seller. Then when we said internal purchases, who is making the purchases? Radio division. So obviously the radio division is the buyer. So it is very, very important to actually first determine who was the seller, who was the buyer. You are correct there. Is that clear?
Okay.
You're not happy?
No, I think it's just one more practice, one more question, sir. Mbeki, are you happy?
Not with two though.
Sorry?
Not with number two.
Number two. Thank you.
No, I mean I'm just getting a bit sidetracked. Like on the part where we are now consolidating into the group. Oh, okay.
Hey guys,
Hey,
this is the
okay, all right,
opportunity.
all right, no, it's okay now. Like I had made a mistake and included trying to do it on Excel. So like I'm trying to do it on Excel, but so I'd automatically put totals and it included the internal cells. Sorry about that.
Fine.
Okay.
Let us do the other part. Trying to go to the question. So this is the statement which we did. Yeah, I think we didn't make some errors. That's fine. Now let's do the other part there. Calculate the effect on the profits of Caroline as a whole if the packaging division is closed and all boxes are purchased externally. Can you guys try just using your Excels there? I give you just 5 minutes. If the packaging is no longer there, what is going to happen? Just a little guess, or I'll give you 2 minutes only.
Okay.
Just 2 minutes.
Wait, Annie, if we close the packaging division and at the moment it's generating contribution of 60, but it will still incur like that the only saving that it would make is 20,000 and the 60 will continue to be a cost. So they would rather just keep it open, isn't it?
Why? Because it's making a loss pen.
Because no, like it's making a loss now, but if it closes, it will make an even bigger loss. Because if it closes, like it will
Because
have
of
to
the
continue
fixed
paying
cost.
60,000. Yeah, it will have to continue paying 60,000, which could be a rental fee, which they were saying could be linked to the contract that they can't get out of.
Oh, okay. All right.
So ultimately, like the profit being made by Caroline would take a knock of 60,000.
Yeah, I think you're right.
Wait, what does it mean? It's currently making a loss of it's currently making a loss of 20,000 with things normal. But if they, yeah, it would actually make it would from what I'm observing and from that 1.4 would have to deduct
Which 1.4?
like the group profit
Wait, let me check.
on Caroline Company, like the last
Okay.
column.
All right, yes. So it just simply means radio division. I think it should continue running. Maybe radio division might back it up in terms of that negative
Back it.
20.
The,
Like
the radio division is the one that was saying this one needs to close.
yes, because it's sucking on their what? On their profits. Because at the end of the day, the group will still get that effect of that $20 because it's covering for the packing division. That's why he's saying that we should close that division.
Oh yeah,
Can you see that?
I think that would be it. Because if they are to close now, and that 60,000 which they have to continue paying persists, they will
It's
only
going to be
save the
more.
20. But the loss will increase.
I think they should just they shouldn't close it in the meantime, but find ways of finding out why they are not doing so well in one of
guys.
their inefficiencies.
Time up.
Parts.
All right, thank you so much for the discussion. It was helpful and eye-opening. But I think that one was for the last part of the question where you were supposed to give reasons.
About 4 marks. Say hold on, please hold on.
Holding.
Hello,
Hey, come
sorry,
on.
multitasking. I was cooking. I've bent everything now.
Oh, we're sorry.
Yeah.
Okay, don't worry. We're
Okay.
about to be through. Okay.
Okay.
So let us just copy and paste our last table and call this one table 2. The true adjusted profit statement. The closure. Closure of what? Of packaging division. So if we close the packaging division, will there be any internal sales?
No?
So you put a 0. Will there be any variable costs?
No?
Put a 0. What about fixed costs?
Minus 60,000.
There'll be minus 60, right?
But 60. Why minus 60,000?
We're given in the story Pezulu where they said that if the division is to be closed, they will only save 20,000, which is linked to the product, but there's the 60,000 which they will continue incurring.
Say, please go back to the story.
I put a star on that. The packaging division's fixed costs relate mainly to long-term lease payments, and only 20,000 per year of its fixed cost could be avoided if it were closed. I see that.
Yes.
Right.
Yes.
So we are left with the 60 there. Okay. Yes, Dave. closed the division, but 60,000 is still being accounted for under that division. Okay? It's a fixed cost. All right. What about for the radio? Hello?
Where are they?
Are you there? Okay.
Yes, sir.
So if we close the packaging division, it means that our purchases are going to be from outside, isn't it?
Yes.
Okay, so we need to open another an entry there. Then our costs or it's our purchases. So let me just say purchases. Okay, how much are they? We are told that they are going for $4 times 20, right? $4 times 20,000 boxes, right?
80 is.
Annie, are you there? Hello?
Oh, she just sent him a WhatsApp message saying she's rejoining. Her laptop just switched off.
Oh, yeah.
So, say, whilst we wait for analysts to come in, this analysis can easily give us 6 marks. Hello?
The 6 marks. That's the it is only based on the theory which we have already covered. That you can now see the clearer picture of it. You understand?
Yeah.
It's different from the situation where we simply just take a past example paper and try to go through it, but without actually understanding the foundations of the subject which is being tested. So right now, you're actually ready for the exam. You can see you're actually ready now.
Yeah, I can see.
That come what may, I want to ace that examination. So you simply have to know which variables have to be changed, and you need to understand the scenario. Every bit of the scenario matters. Yes, every bit of the
That's
scenario
true.
matters.
That is so true. Like this 60,000, for example, you can easily miss it by thinking that they've closed the division.
Yeah. So when they say something has been closed, but there is a fixed cost. Yes, it has been closed legally, but the substance of it is that it is too open because that fixed cost has to be met. You understand?
Yeah.
Mm.
I know, I get it, sir.
Mm.
Oh, I see
Excuse-
analysis back.
All right, she's back.
Yeah, she is.
All right. Hi, Annie. Hello. Yeah, her network.
I think her network is now acting up.
Maybe it could also be my network, but I could hear you guys talk, but it was just giving me a Zoom screen.
Not our screen.
No,
Is
I could just
is
see
it displaying anything?
Yes, now this one is displaying something, but I've got a feedback. It's okay anyway. So I was still analyzing the 60,000 part.
Yeah, the 6,000. We are simply saying that because it is related to a fixed cost which has to be met, we cannot ignore putting it there. All right. It is still being accounted for under the packaging department. All right. All other operations have closed down, but the fixed cost has to be met. So we still put it under the packaging division. All right, for accountability purposes, remember. we can't simply originate a figure into the group accounts without presenting its source.
So,
That's true.
Yeah.
I'm still copying.
Okay. So that was the presentation. I mean the computations which were required. Those were the computations, and
So, say, where did that $80 come from? The internal
okay.
purchases and the radio.
All right.
External,
The
I
intent.
mean.
All right. The external purchases here. We are
External.
simply saying.
Mm.
We are simply saying radio division is still producing radios, and those radios still require packaging. The fact that they have closed the packaging department doesn't mean that they no longer require the boxes. They still want the boxes, but they are now buying them from the outside supplier.
Okay.
Are we to get? Yes. So
Mm.
this is why we got. I mean, this is where we got that 8,000. It is for the
All
boxes
right.
which we are now buying from outside. Okay. Um. Yeah, but you guys and did not notice an omission somewhere somehow. We were only saved by our Excel, formula. You see the direction of our formula on the formula bar there. The formula is actually being driven. This total has been driven by uh, these rows. I mean these figures. But if we had done it vertically, we were going to get the wrong answer because there's a missing -8 here. Are you getting that?
Oh, yes,
Okay.
yes, yes.
we were only saved. We were only saved by this by doing the arithmetic using these two figures. But if we had done it vertically, we're going to get a wrong answer. Okay,
I'm lost.
you're lost again. We are saying
What
the
you're trying
minus
to
eight.
explain.
Okay, the -8 is an external transaction. External transactions are the figures which appear in the group books. Okay, they are not subjected to cancellation on consolidation. They're actually going to be presented. So the 80, which was from external purchases, should also be accounted for in the group accounts. All right. So we had missed it originally. It wasn't there. Okay. But our figure was
What other
correct
group account?
because we had used these totals to arrive at this. Do you understand? But if we had done it vertically, we're not going to get the 1360 there. So this is why I'm saying we had omitted the -8 there. All right. Is that clear, guys?
Yes, it
Oh,
is, sir.
so did you get to explain that effect, that discussion that I'd had with Bege before you intervened?
That was now for the other part of the question. Let us go to the question and see what it's saying. So this is our table, guys. The correct, I mean the examiner's solution. So everything you see the packaging division only has got a schist there, loss, and radio division has made a 142 profit of 1420. And the ultimate profit has been reduced because there is a loss on this, so it has been reduced. Okay, that's great. Now let's talk of
It's reduced because of the loss of the packaging. The group has a
this.
loss because of the packaging.
Yeah.
Okay.
So that's the idea. Um, you can actually see that the difference between this and that is being explained by our schist here.
Yes.
So that's the idea. Now, discuss the advantages and disadvantages to Caroline core of using transfer price of $4 per box. So your discussion, yes, it was good and healthy, but you were not pinpointing which are the advantages and which are the disadvantages. Yeah, say. So here's the explanation. The advantages and disadvantages to Caroline core of a transfer price of $4 per box are: it ensures that corporate profits are maximized. The radio division will buy internally, and the closure of the packaging division will be avoided. So we are saying, if we do not remember, we are talking of, when we are talking of the transfer price of $4, we are simply saying, the question is simply saying, what are the advantages? What are the advantages and disadvantages of continuing to operate the packaging division at a transfer price of $4? All right. So what are the advantages? The advantages are that it ensures that corporate profits are maximized. Yes, in this case, they were maximized because when we closed, the corporate profits suffered from 1,400 to 13,000. I mean to 1,360. Are you seeing that?
Mm-hmm. Yeah.
Here,
Yeah, we are.
here we were maximizing the general, I mean the group wide profits were 1,400, but when we closed, we tumbled to 1,360. So we were not, I mean, we will continue, we will maximize if we continue to operate at a transfer price of $4. The radio division will buy internally, and closure of the packaging division will be avoided, saving the company $40,000. All right, and we know where the 40,000 is coming from. Remember, from 1,400 to 1,360, that's a fall of 40,000 in profit, isn't it? It will also continue to allow the company to control the supply and quality of the boxes which the radios are packaged in. If we continue to have our own division, it will continue to meet our standards and our brand won't suffer. But if we try to get those boxes from outside, some will cut, you will cut corners and produce, Chinese boxes. Just an example. They'll produce those boxes which are a bit substandard, but doesn't mean that all Chinese things are substandard. Some of them are high quality. It's just a slight talk. It ensures that the performance of both divisions is measured fairly, as it is a market-based price. In this way, both divisions will face the test of the marketplace. So we are saying, since the $4 is driven by the market, it's a bit fairer. Are we together? Both the packaging and the radio division will both experience the market touch. All right, they'll be enjoying a feel of the market. It maintains the autonomy of the radio division, as it will not need to be forced to buy internally. However, the autonomy of the packaging division may be compromised, as the $4 transfer price per box will result in a loss, and it may no longer be motivated to produce the boxes. So there will be some conflicts if we continue again to operate at $4. Why? Because the packaging division will feel their work is not being appreciated, because it is always leading them to a loss. So they will be demotivated by the end of the day. Lastly, using a transfer price of $4 per box continues to assume that the packaging division operates as a profit center, but this could be questioned as it has no external market. It may be better to operate it as a cost center. What is the difference between a profit center and a cost center?
I think the profit center is it not where our profits where we control our profits. You said the cost center and the what?
The profit center.
Yes, it's okay, sir. Please share the question so that we can start on it. I think I can do one and you can do one, like the presentation, but we'll work
Yes,
on
That's
them
yes,
fine.
yes.
together.
All right,
We'll work
guys.
on
So
them
I'm
together.
sharing. All right, I'm sharing right away. Thank you so much. Have a blessed day. Thank you. I'll share on the WhatsApp. Thank you.
Okay,
Thank you,
you.
sir. Have a good day.
Bye.
Okay, same to you.
A profit center, yes, where our profits, we can control our own profits, and the cost center is where we can control also all the costs of the division or the organization. I'm not sure. Well, I'm not sure.
Okay. A cost center is only responsible for costs. They do not have an external market. All right. They do not make any profit. They are not responsible for making any sales. All right. That's a cost center. They don't make any profit, or they don't make any sale. So here, the examiner is arguing that if we continue to say we are having a transfer price, we are assuming that these guys have got a responsibility of making a profit. But by default, at $4, they are always going to make a loss. So if they are a department that is always going to make a loss, they should be accounted for as a cost center. Cost centers do not make any profit. They don't sell anything. Their duty is just to incur costs. For example, in accounting department, they're not going to bring any money. They are there to just incur costs. Is that clear? But when you are talking of a
Yes.
department that is going to make a sale, that department could be a profit center. All right. The reason why I'm saying could be a profit center, we are simply saying there's also another department that can also make profit, like, for example, an investment center. So, a profit center, it accounts for both costs and the profits, like division radio, the radio division. It is accounting for both costs and the profits. All right. At a transfer price of I mean, when they are buying these commodities outside, they are making both profits and they are also accounting for their costs. All right, so we can safely say it's a profit center. But the Caroline Company itself is more of an investment center. These divisions are its investments, but it also accounts for costs. It also accounts for profits. So by the end of the day, the parent is actually an investment center. The head office is an investment center. Are we together? So we've actually covered responsibility accounting. Sometimes it comes in your examination, and you need to say something. You must not be found wanting. Is that clear?
Yes, sir.
That's great. That's great, guys. So these were the answers. Let me just show them again on the screen there. That's
Isn't
the
you share the
table.
question even for yesterday, the question paper and the answers?
Oh, you want them? All right, all right. Uh,
Mm.
okay, all right. So guys, that was basically transfer pricing, but I want you guys to do just one question from the June 2018. Let me send again the paper. Just to present, you must love to present, guys. You must love to present, so that we know that we now know. You understand? You must take this
Yeah.
challenge. Otherwise, if I just hold you with a gloved hands, by the end of the day, I'll be destroying your future. You understand? You must learn to get the pain of presentations. You must present things. So I'm going to send you the question I'm talking about, which I want you to present. I also want you guys to present the jellyfish one, because that one is very, very important. So our purpose tomorrow morning, please, is that presentation, and then we'll start something else. Where we are going to embark on is um, CVP analysis, isn't it? Is it so? No. What about
See that
the
there's
special?
another.
Hello?
No, I was about to say there's another problem area and limiting factor.
Please start with limiting factor, yo.
So it's fine. Limiting factor analysis, we're going to do that one. Choose the morning. Limiting factor analysis. Tomorrow, you guys, you come here, you do your presentation, and then a Monday, on a Monday we must finish as early, because Mondays, employers, there's a problem. You understand? So, so you just have to come ready, guys. Tomorrow you must just be ready. 30 minutes jellyfish, 30 minutes this other transfer pricing thing, and then we call it a day. We run to our offices. Is that okay, guys?